Sawhney. So Anil is based in Washington, and it's almost 10:30 in the morning. And we've got Rian in Zanzibar. It's about 1 hour behind from Mauritius. So I'm just going to introduce you quickly to Anil quickly on here. So Anil Sawhney, fellow of the RICS, and he's going to be talking about International Cost Management Standard 3. Anil is the global lead for the construction and infrastructure sector at the RICS. Anil is also a construction and infrastructure sector expert, an educator, a researcher, and a ConstructionTech enthusiast. In his role at the RICS, he's involved in producing construction and infrastructure sector body of knowledge, good practices, practice statement, education, and training. In 2020, he co-authored a book entitled Construction 4.0 Innovation Platform for the Built Environment. He's also currently the co-editor of the Construction Innovation Journal. Anil served on the international editorial board of the IC Infrastructure Asset Management Journal and the Journal of Information Technology in Construction. When I'm saying Anil, it's me, right? So you guys need to call me professor from now on. Okay, fantastic. Anil, so I'm just gonna, we can see your screen and a slide. Take it away. And how long is your presentation, Anil? About 25 minutes, half an hour?
I planned for 20 minutes, but I'm happy to take questions or any comments from the audience.
Yes, so let's keep it for 20 minutes. I just want to increase the volume quickly. And so, guys, can we have a big round of applause for Anil and
Thank you very much. Thank you for inviting me to speak to you today about ICMS. Anil, I missed meeting you when you visited the School of Built Environment in India, so I'm so glad to at least meet you via Zoom. I wish this invitation was in person so I could have flown to Mauritius and presented to you this evening, but I'm still very glad that we got a chance to discuss ICMS. So I'm going to speak to you in sort of an overview terms, ICMS, and something that RICS has produced called the RICS Carbon Toolkit, which is designed to bring global consistency in presenting life cycle costs and carbon emissions. I've dropped in my email address. If anything interests you during my talk, please feel free to reach out to me or to my colleague Bernadette, who's there personally with you. So what I'd like to do today is, assuming that some of you are familiar with ICMS, still try and provide an overview of what is ICMS, then talk about the importance of ICMS by answering this question, why ICMS, and then connect it to how do you use ICMS and the RICS Carbon Toolkit in order to do certain things that our clients, our society is asking us to do on our projects and assets. So let's begin with the first section of my presentation, which is what is ICMS. As you all know, ICMS is not an RICS standard. ICMS has been developed with the help of an international coalition. RICS is part of that coalition. ICMS coalition consists of 50 professional bodies globally, not-for-profit professional associations representing the surveying profession, especially the quantity surveying profession. ICMS began its work in 2015. I'm a member of the Standard Setting Committee, SSC, since 2015. Recently, a month ago, I became the chair of the Standard Setting Committee. So now I'm the ICMS Standard Setting Committee's chair, taken over from our colleague Alan Muse, who recently retired from the RICS. ICMS is a high-level taxonomy and format for classifying, defining, measuring, recording, and analyzing and presenting life cycle costs and carbon emissions associated with built assets. Key terms, high level. So it really does not go down to the level of detail that you would find in a typical cost classification system, maybe such as unit class or other classification systems that are used to provide detailed cost planning, cost management for construction projects, such as even NRM. So it's a high-level taxonomy. What is unique about ICMS now in its third edition is that it integrates life cycle costs with carbon emissions. By design, there are three key features that I'd like to highlight. The first thing is ACROM, which is the high-level taxonomy that we use in ICMS. So ICMS has what we call cost categories of acquisition costs, construction costs, renewal costs, operation costs, maintenance, and end-of-life costs, thereby ACROM. Alongside that, we have acquisition carbon emissions, construction carbon emissions, renewal carbon emissions, operation carbon emissions, and you get the point. The second feature of ICMS is that we have built a set of project and asset attributes and values that drive the cost and schedule of our projects. So these attributes and values of ICMS projects and assets help create information about these projects so that you can utilize them for benchmarking, such as reference class forecasting. But the unique feature which got introduced in the third edition is the integration between life cycle costs and carbon emissions. So that's sort of the high-level introduction to ICMS. We are at an inflection point. ICMS first edition came in 2017, where we started by providing a high-level taxonomy for construction costs or capital costs only. Right after the release of the first edition, we started working on the second edition of ICMS that was released in 2019 by expanding the taxonomy to include life cycle costs. More recently, in November 2021, we introduced or released the third edition of ICMS. What I see personally is that with the first and second edition, it was a very tough hill to climb, because most QSs, most clients, most construction entities wanted to really keep construction costs confidential for obvious reasons. And therefore, we got significant pushback in terms of adoption and implementation of ICMS. With November 2021 third edition release of ICMS, really what has changed is that most organizations want to make carbon visible, carbon transparent. So rather than hiding, to show that we are meeting the carbon targets, you need to show how much is the carbon footprint of your constructed assets and construction projects. So that has shifted and changed. We are seeing a lot of pull from the market for adoption and implementation of ICMS. So because now we have integrated carbon emissions over the life of the project and the asset, the life cycle costs are also becoming more and more attractive to classify and report. So the third edition brings about this very important change, which has led to some improvement in the adoption and implementation of ICMS. So let me, for those in the room who are QSs, and pardon those who are not, I want to first just give a very basic introduction to the core classification of ICMS. ICMS consists of 4 levels. Level 1 is the project or the entity level. Here you have the option of defining project and sub-projects. So if you had a large, complex mega project, for example, an office complex with multiple buildings, you can define individual buildings as sub-projects at level 1, but sub-projects are optional. So you can have a simple single project, a complex project, or a mega project. Remember that ICMS applies to both horizontal and vertical construction, meaning to buildings and non-buildings. So you can apply ICMS to road construction, to tunnel construction, or to residential construction. At level 1, as previously mentioned, we have what's called project attributes and values. These are general attributes and values about the project, entity or project-specific attributes and values, life cycle related attributes and values, and now carbon emissions related attributes and values. Below level 1 is level 2, which are the categories that I described to you earlier, the A-chrome categories of acquisition, construction, renewal, operation, maintenance, and end of life. The categories apply to both cost and carbon data. At level 3, we have groups. These are both cost and carbon groups. And at level 4, you have what's called the subgroups, which are discretionary. This is where we connect to the local levels of classification systems so that you can continue to utilize as a QS your local classification system, but link it to level 3, level 2, level 1, so that your benchmarking database stores information about cost and carbon of your constructed assets using the ICMS taxonomy. So level 4 has been designed to make that connection with regional and local norms. For example, here in the US, the detailed cost classification system used is called master format or uniformat. You can connect both master format and uniformat to level 3, thereby you continue to develop your cost plans using uniformat and master format, but then at the higher level, you can utilize ICMS classification system. This is how the taxonomy looks for the integrated cost and carbon reporting. Notice that we do not look at whole life carbon emissions. We exclude non-construction carbon emissions, for example. We do not discuss income and externalities in your constructed assets. We primarily focus on that constructed asset only. So where we begin reporting is life cycle carbon emissions and life cycle cost for your constructed assets using the same A-chrome taxonomy with reporting groups and subgroups embedded below each of these categories. If you wanted to go into a little bit more detail, this is how level 3 connects to level 2 in ICMS. Notice that the light green boxes are where you're required to report carbon emissions. In all boxes remaining at level 3 group with 2-digit codes, you report your life cycle costs. So for example, you'll be reporting cleaning costs because we're now talking about life cycle costs. Utilities, we'll be talking about decommissioning and decontamination, all your end-of-life costs. Same approach is used for carbon emissions as well. So the acquisition costs and carbon emissions are linked to these 2 boxes of site acquisition and other expenses. Construction, renewal, and maintenance utilize the same groups, these 13, beginning with demolition, site preparation, formation, substructure, structure. Operation costs and carbon emissions utilize these groups of cleaning, utilities, waste management, security, ICT, risk allowance, and so on. And end of life utilize these 7 groups when we report end of life costs and end of life carbon emissions. This is a sample report of a project in the UK. I've removed the identifying information. This is for life cycle costs. As you will notice that this ICMS sample is utilizing comparison between 2 alternatives. Base date is provided. The area is measured using IPMS 2, which is the internal area calculations. Acquisition costs in the first alternative, the land cost is not included. Whereas in the second alternative, you have land costs included. So we report the construction costs, we report the renewal cost over a 30-year life cycle, we report the operation costs over, again, a 30-year life of the asset, and you get the point. You will then be able to see the alternative 1 and 2 comparison for total life cycle costs. notice that some of the information for this project is considered out of scope and therefore has not been reported. So basically, all your calculations sit underneath this sample report, and you finalize the report and provide ICMS-related information at the project level, at the categories level, as shown in this report. This is the second sample report. This one is showing carbon emissions reporting across the carbon categories of acquisition carbon emissions, construction carbon emissions, renewal carbon emissions, operation carbon emissions, maintenance, end of life, and any benefits and loads beyond the system boundary are also included. It tells you basic information. This is a project that has been, again, identifying information removed for a proposed development of residential commercial building 2020 based on a UK planning application. In many jurisdictions now, you're required to report carbon emissions or carbon footprint in your planning or permitting application. The assessment tool used here is One-Click LCA. The database for carbon emission factors is the EPDs, One-Click LCA, and other databases. So the building is about 29,127 square meters. The acquisition carbon emissions are not significant, therefore not reported, and the carbon emissions for the remaining categories are reported both at the building level and at the unit level. You can have another option or alternative for this building, do the same calculations and compare. You can compare the carbon footprint and also the life cycle cost and pick the best option available to you. So what ICMS does is helps you compare options while maintaining the integration with life cycle costs, which is very useful because the cost of decarbonization is equally important when we make decisions on our projects. So that's a very quick introduction to ICMS, but why should we bother? Why ICMS? You know, currently I'm fortunate enough to be able to speak globally to experts like yourself and figure out what's happening in our sector. Most areas are reporting that they use multiple cost classification systems. Life cycle perspective is generally not adopted, as you will all agree. We are very first cost centric, so lowest bidder, construction costs, not really taking into account life cycle costs. Carbon emissions reporting is not defined in most jurisdictions that I have worked with or spoken to, and definitely there is no system that integrates life cycle cost with the carbon emissions. This leads to, and this is a term used by one of our members in Europe, leads to what they call estimating kingdoms. So if you're a large organization, and this is a large organization over Europe, each department, each country, each region is using their own estimating system, and he calls it the kingdoms. Difficult to provide early cost advice because the costs, life cycle costs, and also carbon are not reported in a standard format. So you cannot benchmark and utilize to provide early cost advice. The focus is on first cost because life cycle cost is not used. Costly and difficult to provide cost certainty right now. Difficult to assess the cost of decarbonization. The historical data, because most people do not use standards, are very difficult and not fully utilized. Inclusions and exclusions are not documented, and other challenges, as you all know, come from all these issues are cost overruns on our projects, for example.
Anil, just a quick one. You've got 5 minutes left.
Sure. So we have most countries, regions, companies, organizations setting up carbon targets. While the targets are being set, tools are being built. I recently visited Canada. The government has a greening government strategy where they're talking about carbon footprint reduction, but there's really no internationally agreed classification system for upfront embodied and operational carbon. ICMS fills this gap by providing an integrated standard for life cycle costs and carbon emissions reporting. We did a quick survey of our ICS members globally. About 3,000 responded. You will notice that a large majority, about 55%, don't even measure embodied carbon right now. So if we are to address the climate crisis, we must do something about this. But fortunately, when we spoke to quantity surveyors, we found out that about 90% agree that QSs now need to start playing a significant role in carbon reduction calculations. So how do you use ICMS and RICS carbon toolkit? Currently, if you just look at decarbonization, 27% of the carbon emissions come from operating our assets. 11% come from construction, which is called the embodied carbon. We have various strategies that we can utilize to reduce both operational and embodied carbon. I won't go into detail. What is important for you to notice is that cost management is cross-cutting. You cannot do reductions without having a good indication of what is the cost of these reductions. Bottom line, you need a bill of quantities, bill of materials, project attributes and features, carbon intensity factors, both at the entity and the product level, if you really want to decarbonize. So that again highlights the importance of our members and our members providing services in this space. RICS has produced an RICS carbon toolkit that you can utilize to do decarbonization. There are various resources like our sustainability report, the ICMS standard, the very well known RICS whole life carbon assessment professional statement, which is free for you to download, and several other products, including training available on carbon. Bottom line is that you can utilize ICMS to develop an ICMS-based benchmarking database, both for cost and carbon, for new builds and for existing assets. You can build in your historical database also, and then you can utilize this to give early cost and carbon advice, give investment decisions, and several other things, including enhancing cost certainty. Bottom line is, from my point of view, we as a sector need to start paying more attention to data and technology, utilize common principles and standards, value data and demand data-enriched processes, convert data into information, knowledge, and wisdom, focus on performance and outcomes, and sort out our contractual, technological, and cultural issues. With that, I'm going to conclude. All the information that I just utilized in my presentation, you can scan this QR code and you can download the freely available ICMS standard, the ICMS explained guide, which we released a couple of months ago, the cost prediction professional statement, and the whole life carbon assessment professional statement also. You want to know a little bit more about what RICS is doing on the digitization front. We recently released a digital twin report, digitalization in construction research report in 2022. And lastly, just a little bit plug, you can buy my book on Amazon and leave a good review. It's Construction 4.0, an innovation platform for the built environment. With that, thank you very much for the time. I hope you found the information useful. Please feel free to reach out to me if you need additional information on ICMS and would like to contribute to ICMS adoption, implementation, and development.
Okay, so thank you, Anil. Big round of applause for Anil, everyone. Okay, thank you, Anil. So you can stay with us. We're going to move on swiftly now to Rian Furi. Just quickly for Rian, everyone. So Rian Christopher Furi, a fellow of the RICS Director, Head of Valuation and Advisory Africa. And he's going to be talking quickly on the RICS Red Book update. And then we'll just go back there. So Anil, thank you once again for your time. From the US, much appreciated from all of us from Mauritius. Rian from Zanzibar, thank you very much indeed. A pleasure to have you as well. Can we just say a big round of applause for Rian as well? Rian, take it away and unmute yourself as well.
Oh, God, thank you much. I hope you can hear me. All okay on that side, Anil. Thank you very much for the invitation. And this week I'm fortunate enough to be in Zanzibar for hotel valuation. But I'm going to quickly. There's quite a lot of writing in here, but I'm going to quickly sort of like talk you through the main features and the main sort of like of the Red Book, and then especially focusing on the update. So I'm not going to too much introduce myself, but I'm sort of like head of relations for CB Richard Ellis, and quite a lot of experience in sub-Saharan Africa. So the Red Book has been around. Oops, sorry about that. The Red Book has been around for since 1974, and recently, well, if I said recently, in the beginning of the year, it was updated with a number of small changes and things valuers should take into consideration when preparing valuation reports and how they write about reports. A lot of focus on sustainability and performance certificates on properties, and incorporating that into the report to their clients. So essentially, the Red Book comprises about just about 300 pages. It's downloadable from the RICS website. If you just search for a Red Book or for the International Valuation Standards, and essentially the Red Book is divided into two portions. It's got the RICS Red Book, and then as an annex here or within that sits the International Valuation Standards. The structure of the Red Book is essentially as follows. This is just sort of like a brief overview of what it provides. So there's 2 RICS professional standards. There are 5 technical standards, and then are 10 global practice guidance applications. And those normally change, through time, as the RICS provides more guidance for valuers on how to value certain type of properties. And then, as I said, to the back of that, the RICS Red Book is the International Valuation Standards. So within the valuation standards, obviously we've got the 5 methods of valuation which valuers normally refer to. So those are the methods: the income, comparable, profits, depreciation, replacement cost, and residual method. And this is just a bit of more breakdown about how we use those, and I'll end at there. So as income method is direct capitalization and discounted cash flow. So within the Red Book, the RICS actually, the Red Book doesn't tell you how to value it. It just tells you which methods you can use and where they fall into. So what is the income, the comparable, the profits method, depreciated replacement cost method, or the residual method. What we're paying quite a lot of attention to recently since the COVID outbreak and everything that's happening in the market with the war between Ukraine and Russia is obviously valuation practice statement guidance note number 10, which is material valuation uncertainty. So there's a lot of attention being brought to that and written into, this is essentially a clause from one of our reports that we write into the reports for our clients to say what's happening with the current market volatility with COVID, the war in Ukraine, and how it will affect valuation reports and reporting. And particularly, there's a lot of talk around inflation, lending, and investment caution, as which has also been advised for the client to take into consideration. Then, so coming back into the update and the key changes. So the key changes are essentially the RICS sort of like said to emphasize the need to agree on clear and ambiguous terms of engagement. So when you're engaging with your client, exactly describe what you're doing, and it should be clearly conveyed through to your client in the terms of engagement. Then secondly, they recommend that you should not mention anything about the fact that it's a non-Red Book valuation on any of those terms be used in engagement or reporting. And then most importantly, actually, is point number 3, which is the reporting requires more detail regarding sustainability, resilience, environmental, social, and governance matters. that they want you to disclose when you're valuing a property. I want to go on to point number 4, because that is sort of just relating to trade-related properties. Then, so what does it mean in practice? So in practice means, and South Africa has certainly been, with the South African Property Owners Organization, also the owners of buildings have a performance timeline. I think it's now been extended till 2025 for them to have energy efficient certificates and standards in place in their buildings, and making sure that the buildings comply to the current standards. And that is going to obviously, as a result, they will put a bit of pressure on property owners, and that to get it's going to be a capital expenditure, more than likely to get their property up to certain performance measures and standards. It will obviously have an impact on evaluation as well when you're doing a evaluation report, and you've got to allow for capital expenditure to be taken into account, maybe in the short term, to be spent to get the building into the proper standards or conditions for energy performance. And obviously, a notable factor as well is your yields used, and your the way that you value the property will be affected by the efficiency the building is producing. And obviously, the less energy efficient the building is, the riskier the capitalization rate would be as a result. Within evaluation reporting, our clause that we particularly use is, we will say that sustainability is for the purpose of these standards taken to be mean the consideration of matters such as, but not restricted to, environmental and climate change, so health and well-being, and personal and corporate responsibility that can or do not impact on evaluation of assets. In broad terms, it's a desire to carry out activities without depleting resources or having a harmful impact. Quite a note here as well from this. Actually at the moment, no recognized globally adopted definition of sustainability. Therefore, members should exercise caution over the use of the term without additional appropriate explanation, and that's especially in the reporting, how they refer to certain things. And then coming to our reporting, how we write that in is into our reporting for our clients is, we normally say that wherever appropriate, sustainability and environmental matters are an integral part of the evaluation approach. Sustainability is taken to mean the consideration of such matters as environment and climate change, health and well-being, and corporate responsibility that can or do impact on the evaluation of an asset. In evaluation context, sustainability encompasses a wide range of physical, social, environmental, and economic factors that can affect value. As we said before, for instance, if you are valuing for instance, an industrial property and looking at sustainability, we've done it in the past as well, where the industrial property might be too large, and it's not a sustainable asset to have going further into the market, where, for instance, unit sizes and requirements of clients change, and I want the smaller units. You need to comment on that sustainability of that warehouse as a large warehouse in the market. And obviously, in that regard, we will most likely make recommendations to the client, and we'll say, well, we recommend that they would spend a bit of capital expenditure on the property and divide that unit into smaller units. So we're looking at what is sustainability of the property, and what is we're advising our client as well how they can change the property within a more sustainable future going forward, obviously. And then just to carry on there, the range of issues includes key environmental risks such as flooding. We see that as well in the UK when I was working there as well. There's always been comment on flooding water lines and everything like that, affecting the property if it's and especially with the change in globally in the weather conditions. That's quite an important thing to value and put into your report. We certainly in our reports, when it comes to that as well, report on the weather conditions as well when we inspect a property. For instance, to give you an example, if we inspect a property on a rainy day, there could be some flooding or something like that, which on a dry day, it might not be some flooding. So it's important to make sure if that flooding is a normal occurrence or something has gone wrong with the property. So that's how we report from that point of view. Then energy inefficiency in the climate, as well as matters of design, configuration, accessibility, legislation, management, fiscal considerations, and current and historical land use. These are all things like, as well, for instance, if you've got office, it is sustainable now, especially in this environment, to keep that as an office, where a lot of certainly in the Johannesburg and Sandton region, a lot of buildings, sort of like the average vacancy rate is about 25 to 30% on offices. A lot of the funds and the investment trust and that is looking to change those properties to residential properties. So there's a lot of pressure on them to convert it to actually, let their properties performing better in the future. And then so finally, sustainability has an impact on the value of an asset, even if not explicitly recognized. The value reflects markets that are not there to lead them. And where we recognize the value impacts of sustainability, we are reflecting our understanding of how the market participants include sustainability requirements in their bids and the impact of market relations. A quite important thing as well as part of sustainability, what we, I was going to move that, sorry, I don't know if that's in your way. Another thing we actually comment on and value within our reporting as well as green premiums as well, which you have like, for instance, is two examples here where you would have a green star rated building and how that is seen and valued with regard to normal buildings. Is it more valuable than a normal building? How does operating costs and things work? So that's sustainability factor and an energy performance factor that's been taken into account. And then the other one, the second one to mention is a list of quite a number of them, but the second one to mention is then solar energy income. So if you had, for instance, a shopping center with solar panels and that contributing to the property, how does it benefit the property? How does it benefit tenants and the overall operating cost of the property? And then that's concluding me. I'm essentially back again in Mauritius in sort of like the in person if Anil will allow me to be there. I'm sure he will, so it'll be towards the end of March. And then we did a sort of like a workshop in a couple of years ago on our RSA's Red Book, which is quite an in-depth the review of the Red Book, which is quite well received. I think it was over 110 people in the seminar at that point in time. So I think we're trying to do something similar again in March, and then we're looking to do some workshops again as well on valuation methods, and then especially part of getting my fellow membership of the RSCs. I spend a lot of time going into Africa and then teaching people about the RSCs, and then also providing a sort of like interview guidance and questions and answering techniques to them. So we'll have a session on that as well towards the end of March. But that's my details for you. If you I welcome you to speak to me or drop me a WhatsApp message. I'm normally quite quick on answering on WhatsApp. That's how I work. And then I've got 2 email addresses. If you want to contact me there, if you need some counseling or guidance or something in relation pathway or commercial pathway, and that I'm happy to assist you on that. That concludes my presentation for today. Anil, thank you. Thank you for the invitation.
Okay, so big round of applause, everyone, for Rian.
Thank you.
Thank you, Rian. We've got 2 minutes. Any question for Rian on our educator? Are there some of the barriers over here as well? Okay, so Rian, I think we're good to go. Thank you very much indeed. We've got a 5-minute panel discussion. We've got a 5 minutes panel discussion, which we will do in person here. But as always, Rian, thank you very much indeed for giving back your time. And hopefully we can see you next year in March for a in-person event. Yeah, thank you. So once again, Rian, always grateful for your time and effort for our small island of Mauritius and to our ICS. Guys, once again, was good job for everyone. Okay,
Yeah,
Rian,
thanks,
thank
Anil.
you.
I just want to say thank you for the invitation and thanks for doing giving back to the industry as always, and for the invitation and the same to Bernadette as well. It's good to see you. I think we haven't met in person for a long time, but we'll see each other soon. Thanks for everybody for contributing to the membership. I appreciate it very much.
Okay, so thank you very much indeed, Rian. Thank you.